All right, so update on what's happening to the markets and how we can take advantage of the recent price action. So starting with the S&P 500, the last couple of days we have seen a shift in sentiment from really bearish to now beginning to be kind of bullish. All right, so first, if you take a look at the daily candles, you can see that we had a bit of capitulation, right, where the markets fell pretty steeply. Remember that in order to form a bottom, the markets normally have to drop in a parabolic fashion, which means the market drops 90 degrees. Usually on a downtrend, markets fall on a 45-degree angle, and then it drops 90 degrees, and then it reverses back up. So this could be a potential bottom. Now, is it the bottom of the year? No one can predict for 100% certainty until it proves itself, but this could be a potential bottom for the year. And I use the word again, potential. It's like you're meeting someone, right? Could be a potential girlfriend, meets all the criteria, but will she say yes when I ask her to marry me? Well, I don't know until it actually happens, right? So why do I say that this could be a potential bottom? Number one, again, if you take a look at the price action, you do see a bit of a steep drop here, which is a good sign. We want a steep drop. We want capitulation. People panic. Markets tend to bottom at the point of maximum pessimism. When people freak out, that's when it bottoms. And it actually hit close to a 20% mark. So it like almost went into a bear market and then it reversed back up, right? So we had that bit of a reversal in the last couple of days. Now, if you take a look on the weekly candles, last week we closed with what is known as a bullish pin bar candle, right? Bullish pin bar. Now, some of you are thinking, but Adam, it's red. How can it be a bullish pin bar? Now, if you've learned candlestick patterns, you know that for bullish pin bar, you just need a small candle body with a long lower shadow. The color of the body doesn't matter. It can be a red or white body, doesn't matter. What matters is the shape. So when you get this small body and long tail, we call that a bullish pin bar. And a bullish pin bar is a potential reversal pattern. Now, again, it's not a guarantee. What I'd like to see is that this week, we're able to close another bullish candle by Friday. So if we can close, right now it's a bullish candle, but anything could happen. It could reverse to a bearish candle, right? So if this could close by Friday above the high of this candle, that would be a very, very powerful signal of it being the actual bottom, but not yet. Let's see if that happens. Now, let's go back to the daily candles. So on the daily candles, you can see we had 3 pretty strong bullish days that have kind of like shifted at least the short-term sentiment from really bearish to now a bullish sentiment, right? In fact, if you take a look at IBD, Investors Business Daily, which is a very followed site for momentum trading, you can see that they've actually indicated that the market's in a confirmed uptrend. And this is from William O'Neill's research. So yes, it is a confirmed uptrend in the short term. But again, is this the bottom? Will it recover to all-time highs? Remains to be seen. Now, for that to happen, it has to obviously break through some levels of resistance. So let's take a look at what are the potential resistance levels that we need to watch when this happens, right? So again, if you listen to most people will tell you that, hey, this is a bear market rally, right? So what's a bear market rally? What they're saying is that we're in a freaking bear market, right? We're in a bear market, right? So this is just a dead cat bounce. It's a bear market rally. Don't be too happy because it's gonna come back down again, right? So is this a dead cat bounce? Is this a bear market rally? Well, you don't know until it happens, right? So remember that every successful market reversal always starts with everyone thinking that it's a bear market rally, when everyone thinks it's a suckers rally. Now, you guys remember this very famous psychology chart, right, on market psychology. I'm sure you've seen this online, where the different emotions that a market goes through in a market cycle, where you got this boom cycle, the bust cycle, it bottoms, and then it starts a new bull run. And remember that every bull run always starts with the majority of people in disbelief, that are very skeptical. And most people say this is a suckers rally, this is a bear market rally, don't trust it, right? Everyone says that, right? Until by the time they find out it's real, by the time they think it's real or they know it's real, prices would already have gone up so much and stocks would be so overpriced by then for you to jump in. So again, as an investor, by the time you want to wait for confirmation that it's really real, it's often too late, right? You have to start investing even when people are having a lot of fear, uncertainty in the markets. That's how you still buy when it's undervalued. So let's go back to the daily candles on the S&P and let's take a look at potential resistance levels that I'm watching, right? So right now we are bouncing off these lows, and I would say the first level of resistance that we need to watch for is this 20 moving average, this red dotted line. So you can see that this acted as a bit of a resistance earlier, right? It hit that resistance and came down. So now this red dotted line, the 20 EMA, could be resistance again. Now, at the same time, this coincides with the 61.8% Fibonacci level. So we're definitely watching this level at 4137. So in other words, let's see if the market can break above this resistance, or will it hit the resistance and come back down again, right? So again, for those of you who are looking to hedge your trades or hedge your portfolio, you could look at this level, right? So the moment you see that there's kind of like a bearish reversal candle pattern at this resistance level, you could put in some short hedges. So in our options class, we are using bear put option spreads, where we buy a put over there and we sell a put down there, and we could take profit if it comes back down again. So we are watching that level. Okay, now if it breaks above that level, where's the next potential resistance if it breaks this level? Well, the next resistance would probably be the 50 moving average on our daily candles, and this roughly is at about 4320, about that level, right? So this is a 50 moving average, and again, if it breaks above that, it may hit this resistance, and could it come back down, be a dead cat bounce? We are watching these levels right here. So again, this could also be a level where one could hedge your portfolio, enter some short positions, bear put option spreads to hedge reversal back down. But again, remember that when you put in these hedges and the market indeed breaks out and goes to all-time highs, then you will lose money on those hedges. So when you use hedges, you got to have stop losses. I prefer to use options because when I use options, the risk is limited, right? If it does go up, I lose very little on the options, but if it does go back down, I make a lot of money on those bear put spread options, which would then hedge some of the short-term unrealized losses of my long investments or long trades. So personally, do I think that this is the bottom, or do I think that this is a bear market rally, is going to go back down again and form another bottom? Honestly, I'm still 50-50 right now. But I will say this, even if this is not the bottom, I think the bottom is going to be pretty close. So even if it does go up and come back down again, I think we're going to make another bottom really, really close. And I still believe that the second half of the year is going to be really bullish. And we're going to end this year not as bad as where we are right now, or even we could still end up positive. Some of you are thinking, are you nuts? How could we end up positive when we started so badly this year? Well, you never know. And again, it ain't over till the fat lady sings. And here's some interesting history. As you guys know, I'm more of a historian than a technician, right? So I love to look at history to learn from history. Now, if you take a look at the last 40 years, back to 1980, and we look at the S&P 500. Now, what's interesting is that during a year, the market can drop a lot or go up a lot, but ultimately, it will close somewhere. And there are many years where the market drops by more than 20%, like where we are right now. In fact, the S&Ps dropped almost 20%, right? But by the end of the year, it closed back up positive, or it closed back up, say, down 5% or down 10%, a lot better than the lows of the year. And this happens pretty frequently. So let's take a look at the last 40 years of S&P data to show that, it could happen. You never know, right? So now, these triangular green thingies. Is it green? I don't know. It's green. Maybe I'm colorblind, right? So these represent the intra-year lows. That means how low it went during the year. And these green bars represent how the S&P actually closed for that year by the end of December, right? So you can see that there were many, many years where intra-year, the market went down to near 20%, right? So for example, in 1980, you can see it dropped kind of like 18%, but by the end of the year, it closed up over 30%, right? So this red dotted line represents the 20% level, right? So that ended really bullish. How about in 1981? 1981, again, almost dropped 20% like where we are now, but by the end of the year, it ended down only minus 5%. So there was a big rebound during the second part of the year, right? How about 1982? Well, 1982 market went down again, intra-year low of about 18%, but ended up the year over 20%. What other years came close to this 20% drawdown that we have? 1990, right? 1990, you can see same, right? It went down close to 20%, but by the end of the year, it rebounded so that it only ended the year down like, probably this is like down 3%, something like that, right? How about 1998? Same thing. Intra-year down 20%, but by the end of the year, it ended up, right, like close to 30%. That's amazing, right? What else? Oh, forgot about this year, right? 1987, right? That was a big black market crash, right? 1987, this was crazy, right? During that year, the market dropped down more than 30% intra-year, but by the end of the year, it closed up like 5%. I mean, that was nuts, right? Really crazy, right? Okay, now, how about over here, the year the year 2000. So this was the dot-com crash, right? Dot-com crash. So the dot-com crash was one where it ended the year just as bad or worse, right? So you can see for this one, 2001, intra-year low was minus 30%, but it ended the year down 11%. Well, it still ended up better, all right? Still ended up better, right? Year 2000, intra-year low was minus 35%, but ended the year not so bad, down 20%. So there was still a rebound towards the end of the year, although it still ended down kind of like double digits, right? And that was during the dot-com crash. How about the great financial crisis, the subprime crisis? So that was in 2008, 2009. So 2008, my God, intra-year drop was freaking minus 50%, okay? And it ended the year, not as bad, but still pretty bad, ended the year down kind of like 38%. So this was the great GFC, the great financial crisis. Now, what's next? How about 2009, during the financial crisis, right? Intra-year, it dropped kind of like almost 30%, but ended the year up like 28%. So 2009 ended the year way above where it was in the middle of the year, right? How about 2011? 2011, same thing. Intra-year, S&P dropped 20%, but ended the year still positive. You can see it happens pretty often. It's not that rare, right? How about 2018? 2018, again, intra-year, it hit the 20% mark, but ended the year only down 5%. Huge rebound towards the second half, right? We talked about this already, yeah? And of course, 2020, the COVID crash. Intra-year, the market dropped 35%, but ended the year up kind of like 18% over there. So looking back at history, you can see that with the exception of 1 year during the dot-com crash and 1 year during the great financial crisis, apart from those two exceptions, for the rest of the years, when the market was down 20% or more, it ended the year up or not as down, right? Now, some people are comparing, hey, but could this year be like the dot-com crash or the great financial crisis? I've said many times, I seriously doubt it, because the economic and financial conditions today are very different from the dot-com crash and the great financial crisis. Now, during the dot-com crash, recall that at the time, the 10-year yield, right? The 10-year yield was higher than the earnings yield on the S&P 500. Simply what that means was that during that time, stocks were more expensive than bonds. So it makes sense for people to sell bonds, or rather sell stocks and rotate into bonds. So stocks had a long way down to go. But in today's case, that's not the case, right? In today's case, you find that the earnings yield on the S&P 500 is 5%, whereas the 10-year yield is 3%. So in other words, stocks are still cheap relative to bonds. So it's a very different condition. And at the time, during the dot-com crash, many of the technology stocks, a lot of them were way overinflated, way overvalued, and many of them were not making money, all right? Whereas if you look at a lot of the mega tech stocks today, Microsoft and Amazon and Google and Facebook, they are making a lot of money. They are extremely profitable and they are not that expensive. In fact, a lot of them are undervalued right now. So it's a very, very different condition, right? How about the great financial crisis? That's really different because now what mainly caused the great financial crisis was that a lot of financial institutions like banks almost went bust. Why? Because a lot of the assets they held, those mortgage-backed assets, became worthless when the real estate market collapsed. And during that time, banks were highly leveraged. Individuals, their balance sheets were highly leveraged. In other words, they had a lot of debt. Now, that's not the case today. Today, banks are very well capitalized. They've got a lot of, they've got very strong balance sheets, as well as the consumer, the US consumer, still has a strong balance sheet. So it's a very, very, very different time, right? So to summarize this video, what I'm saying is this. What I'm saying is this, that yes, the S&P has dropped 20% right now after 5 months of the year. People are freaking out. The NASDAQ has dropped, over 30%. People are freaking out, okay? And there are people I know who are selling. Is going to get worse, right? But what I'm telling you is that based on history, now is the worst freaking time to sell. It's the worst freaking time to sell because odds are that the second half, all right, is going to be extremely bullish based on what we've learned from history. And we may even end up the year positive, or even if it's negative, it will not be as negative as where it is today. All right. So again, am I saying that this is the bottom? Maybe. But even if it isn't the bottom, I think the bottom is pretty close. We could have a bit of a bounce, do a second one, and then eventually it's going to go back up. So ultimately, how do you use this knowledge as an investor or as a trader? Right? Very simple. First of all, from an investment perspective, you guys know who are in my community, I have continuously been buying stocks. Almost every day I've been buying stocks. Why? Because they are undervalued. But I buy stocks of great companies that are really undervalued. In fact, if you just read yesterday, Warren Buffett reported that he just invested $3 billion in Paramount and $3 billion in Citigroup, right? Now, bear in mind that banks are very cyclical companies, which means banks, they do really badly in a recession. Now, think about it. If the majority of people are saying that a recession is coming, why is Warren Buffett buying a freaking bank if a recession is coming, right? Few reasons. Number one, he don't think a recession is coming, right? Or number two, he thinks a recession is coming, he don't give a fuck, okay? Either one, right? But seriously speaking, if you look at the best investors in the world, they do not make their investment decisions based on predicting the economy, because no one can predict the economy. Not even the Fed chairman can predict inflation or long-term interest rates or the recession. No one can predict it, right? And the greatest investors in the world never make decisions by predicting where the market's going to go in the short term. They don't. They simply look at the business behind the stock. As long as it's a great company, it's making money, generates free cash flow, growing consistently, and is undervalued, they keep buying. And that's what I've been doing. So, I always say that short-term market predictions is anyone's guess. Anyone's guess whether it's going to be a recession or how deep it's going to be. So from an investment perspective, I'm still buying stocks. And you guys in my community, you know what I've been buying every day because my alerts are going out to you guys. Now, from a trading perspective, from a short-term trading perspective, based on this short-term bullishness, I am looking to take some bullish short-term trades. Maybe later if I see some compelling trades, but with very tight stop losses, obviously, right? And of course, using options, I will exit manually once I see a change in the short-term trend. At the same time, if I see the market hitting levels of resistance, I may take some short-term swing trades as well by going short on the index using bear put spread options. So again, if you want to learn how to invest in the best companies in the world, right, learn. You can learn how to do it. That's what we teach in our value momentum investing course. You want to learn how to trade, swing trade, whether trading long or trading short. That's what we teach in our stock trading courses, as well as our options courses and options masterclass. So again, I always say this, that we can't change the world, but we can change ourselves. We can, don't wish for the world to change or the world to be better. Focus on making yourself better so that no matter what happens in the market in the short term of the economy, you know how to deal with it, you know how to profit from it, and you know how to keep growing your wealth and investments. So may the markets be with you, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.